Welcome back to this ASC 210 explainer. So, if you were with us for the last module, you'll remember we firmly established the balance sheet as a financial snapshot, right? We talked about who uses it and what it tells you. Well, before we jump into our next deep dive, which is going to be all about specific assets, we really need a bridge. We need to understand the absolute mechanics of exactly how that snapshot is built. So today, we're focusing entirely on the engine under the hood, the accounting equation.
Okay, just taking a super quick look at our agenda today, we're going to cover the golden rule, define the core components, see the balanced equation in action, talk about what happens when that balance totally fails, and finally, rearrange the whole thing to pull out some analytical insights.
All right, let's jump right into Section 1, the golden rule, which is the mathematical foundation of accounting. Assets equal liabilities plus equity. We are starting with a fundamental anchor of this entire training course. And this brilliant formula, it isn't just some industry convention or preference. No, it is literally the mathematical law of physics for business. Every single transaction your company makes, every single journal entry your team posts, must leave this equation perfectly balanced. No exceptions. Moving right along to Section 2, let's actually define these components and break down what makes up the equation.
To truly grasp how this balancing scale works, we need strictly defined building blocks. First up, we've got assets. By definition, assets represent everything of economic value that your business owns or controls that will provide some future benefit. We're talking about cash, inventory, buildings, software licenses. Honestly, even that ancient espresso machine in the break room counts, provided it brings economic value to the business. If your company controls it, it belongs right here in the asset bucket.
Then, on the other side of the scale, we have liabilities. These represent everything the business owes to outside parties. Classic examples are things like bank loans, unpaid employee wages, and taxes. But interestingly, it also includes advance payments from customers because, think about it, if a customer pays you today for a service you haven't actually delivered yet, well, you owe them that service. It is a strict, unavoidable obligation.
And finally, we have equity. You can kind of think of equity as the residual interest. It's exactly what's left over for the owners once all of those liabilities and debts are completely settled. This is typically made up of share capital and retained earnings. And I think this brilliantly illustrates the core dynamic at play in every single business. You have this constant underlying tug of war going on between the valuable resources a company controls for its future, the assets, versus the strict obligations it owes to others, the liabilities. Equity is really just the referee. It's the net result of that tug of war. Okay, on to Section 3, keeping the equation balanced, where we'll see double entry accounting in action. It's one thing to see the equation on a whiteboard, right? But it's another to see it absorb the chaotic reality of daily business. Let's follow a company's journey here. Notice how every single action impacts at least two accounts. You borrow 100 grand from the bank? Well, assets go up, but liabilities also go up. Balanced. An owner invests 50 grand. Cash goes up and share capital goes up. Balanced again. Or what if you buy equipment for 20K in cash? That's actually just a swap within your assets. You gain equipment, but you lose cash. The total equation remains perfectly balanced in every single scenario. Now, a really crucial point to note here is how profit interacts with this formula. When a company earns a profit, that money flows directly into equity via a line item called retained earnings. Literally every dollar earned that isn't paid right back out stays exactly there. This is exactly how a profitable company organically swells the owner's stake over time.
But what happens when it all breaks down? Let's get into Section 4, when the balance fails. This is the absolute red alerts of accounting.
We've just seen how elegant the math can be. But seriously, what actually occurs when the math breaks down? You really have to ask yourself, what does it practically mean when your total assets suddenly do not equal your liabilities plus equity? If the literal law of physics says they must balance, what exactly has gone wrong? Simply put, an unbalanced sheet instantly signals a severe recording error. And there are some really common culprits for this. Maybe it's a journal entry posted to only one side without a matching credit. Or a simple but super frustrating human transposition mistake. Typing way too fast and entering $19,500 as $91,500. Or what's highly common today, a totally broken formula or mapping error in your reporting software. This leads us to an ironclad rule that you've got to adopt immediately. Never present a balance sheet that does not balance. If it's off by even one single penny, you have to stop and investigate. I mean it. An unbalanced sheet isn't just a rough draft, it is fundamentally completely broken. It completely invalidates the financial snapshot we talked about in the last module. Finally, Section 5, Rearranging for Insights, where we transform these rigid rules into analytical tools. Let's transform this rule into something incredibly powerful. By simply shifting the equation to assets minus liabilities, you instantly uncover the company's equity. Think about it like this. If you take everything of value the company controls and immediately paid off every single debt today, whatever is left over is the equity. That's often called the company's net worth or net assets. Similarly, flipping the formula to assets minus equity clearly isolates exactly what the company owes to the outside world. If you subtract the owner's stake from your total resources, the absolute only thing remaining is the measure of your external obligations, your liabilities. Now, next time, we're going to dive straight into the assets side of this equation to explore the massive difference between current and non-current resources. But as you master this equation today, I want you to keep this balancing scale in your mind. Because if every single transaction alters this balance, what true story is that final net worth number telling about the health of your enterprise? Is your equity growing organically through hard-earned profit, or is it secretly shrinking under the weight of mounting liabilities? Think about that before our next lesson. See you then.